Well, after volatility gripped markets towards the end of 2018, markets have since made quite a remarkable recovery to kickstart 2019. The three T's seem to be behind some of those moves. We have tech, trade and Trump. We've managed to recover more than half of the losses from the last quarter. For more on whether this volatility continues and what to expect for the rest of the year, I'm very pleased to welcome Tony Sacre, CEO of the Bentleys Network, who joins us live in the studio this afternoon. Tony, a pleasure to have you on.
Thanks very much,
Thanks
Leanne.
so much
Happy
for
to be
joining
here.
us. Look, volatility seemed to have been the buzzword, certainly towards the end of last year. I know that for US stocks, I mean, December was a really dismal performance, the worst performance that we'd seen, I think, since the Great Depression. But since then, we've kind of started to recover. I suppose when the US sneezes, the rest of the world catches a cold, and Australia is not immune to that. What do you think about the prospect of this volatility, this wild ride continuing this year?
Sure. No, it's a question I think that's at the forefront of many people's minds, realistically. And unfortunately, I think that volatility is here to stay for the year. But volatility doesn't necessarily mean a bad thing. I think it has a negative connotation. It does present opportunity to people, right? Yeah. But I guess thinking about the reasons why volatility is here, certainly the US and China, when they catch a cold, the rest of the world, does also, of course. Yeah. But I think if you look at the US and China and many of the other areas around the world, there is the perfect storm for volatility reasons. So there's economic concerns and there's political concerns. So with the US, of course, there's pretty obvious political concerns around how the Trump administration is going to going into the second period of his term. But also, you're quite right, as regards to their economy, it has certainly started to come off over the past couple of months. Realistically, the growth that I think you saw in the US for the past 2 years was really as a result of the tax cuts that the Trump administration put through early on in its administration, and the US is really starting to come off that sugar fix, if you will. China gets some interesting press around its growth ratio. So it's 6.6% growth at the moment, and people, I think, have become or had become accustomed to 10%, 11%, 12%. But people have got to remember now it's off a lot bigger base now. So China is 6.6% annual growth of a very developed economy. The 12% that we were used to in the past was really when it was developing as an economy. What does that mean for market volatility when we look at Australia as well? Australia is also looking at some volatile times going ahead. You've got a country heading into the federal election, of course, so that creates some uncertainty for markets. You've got some very front-page news scenarios occurred last year, particularly if you look at the Royal Commission, of course. That created volatility in the markets as well. So I think overall you will see a relatively volatile market for the majority of 2019.
The US-China trade war, again, as a big kind of macro theme, keeps coming up in conversation. In the last few days, we've been seeing those officials meeting, and we don't have any real detail yet at this point. There seems to be slow and steady progress from all accounts. But what is your view on how the trade war is kind of progressing and the impact, perhaps, that it will have on Australia and Australian businesses in particular? Look,
indeed, and I think that's the focus of a lot of boards around the country right now. But the understanding, you're quite right, is that the talks are progressing quite well out of Beijing. The detail is scarce, to say the least. But even if worst-case scenario the trade war were to linger on for a period of time, the amount of points that would take off the actual Chinese growth numbers for the 2019 year isn't substantial. It doesn't go from 6.6% to 2% growth or anything like that.
And so, I mean, 6.6% growth is still a really, really strong growth level.
It's a great level. And when you think about where Australian exporters typically do have as one of their main markets, that strong level of growth is quite significant for exporters as a region for which we'll be selling most of our products, or a fair proportion of our products. But notwithstanding that, there is also other markets which I think Australian exporters do focus on as well. And India's obviously had a very good year last year and is showing very positive signs after a period of what seems like a long period of malaise, but it is starting to come out of that, which is very beneficial as well to Australian exporters.
Absolutely. So from a market perspective, I mean, we look at the 200, and yes, we've started to see a recovery at the start of 2019. I think we mentioned it right at the start there. We've managed to recover, I think, more than half of the losses that we've seen over the last quarter or so. So things are certainly improving, and a lot of the flush out perhaps that we had just before Christmas was maybe exactly what the market needed to kind of reset and rebase ourselves. What do you think? What's your prediction as to where the ASX ASX heads this year?
Yeah, look, I'm cautiously optimistic. I mean, naturally there'll be sectors that I think will experience some difficulties and some headwinds, I suppose, but there are others that are well positioned. So if you look at those that might position some sort of difficulty, I think the generic banking sector, if you will, might experience some problems as they try and enact and get their policies and procedures in place in line with what the Royal Commission is expecting, what Haynes' work had dictated. So, and the banks are a very major component of the ASX 200, of course. But then on the flip side, you've got an Australian dollar that's lower. It's nice and around 72 cents. It's no longer up in the 80s. So that is very advantageous for the export sector for Australian markets. So whether it's the resources sector from what we traditionally know as exporters, so coal, iron ore, copper, natural gas, but also the agri sector, the dairy sector, the healthcare sector, pharmaceutical sector. I think these groups that do have a strong export focus, with the currency around its typical mean of 72 cents, that's quite a good sign for Australian exporters, I think. And so what that will mean is whilst the banks might drag down part of the ASX 200, I think the other sector will bring it up. So I am cautiously optimistic over the 12-month period.
The impact of the housing market as well keeps coming up, and we saw those retail sales figures coming through today, which actually look pretty solid. But then you consider the backdrop of the housing market and you just wonder whether that strength can continue for the rest of the year. What about the implications, though, from a slowing housing market and this so-called negative wealth effect that we continue to talk about? Will that still have implications for the market this year?
I think it absolutely will, and we'll see it most likely in the first half rather than the second half of the year. You look at what happens when there's a reduction in people's wealth effect, they spend less. And as a result of that, at the same time as that, you've got banks that will probably at the very least slow down their capacity to lend to whether it's the housing sector or whether it's businesses in general. So this is going to have that impact. And then with the political environment that we have in Australia with the election coming up, naturally firms are reducing their capex at this stage of the cycle. So what you may see is a bit of quietness leading into the election. Post-election, almost regardless of whoever wins, you will see a natural pickup off the back of that. So you'll see capex increase. Hopefully we'll have seen the banks got through their administrative difficulties so that they can then relaunch lending to the market, because obviously the housing sector is very significant to how the average Australian does approach their wealth effect and how they adjust their spending accordingly. So
Tony, we've spoken about a couple of the sectors that we'll be watching, those that may be beneficiaries and perhaps not do so well this year because of all of those factors at play. How do you think investors should be positioning themselves when you consider their asset allocation to perhaps weather some of the storm going forward and weather some of this volatility?
Yeah, sure. I think I think the key ingredients that came out last year is investors, when they're talking with their financial advisors, they have to make sure they've got a financial advisor that can really listen to their growth and aspiration and where the investor wants to come to an end game. I think there have been previously investors that have had poor advice and sort of short-termism. We've just spoke about at the start of the discussion that volatility will be high, and I'd hate to see investors get too focused on trying to capture this opportunity in the market, and then they miss it because of a timing.
You can never pick the highs and the lows, right?
Indeed, it's very difficult. So from that perspective, I would encourage investors, it is going to be a volatile year. Stick to your long-term strategy, of course. Talk to your financial advisor, work out your goals and aspirations, and really methodically stick to your plan, because I think this will be a challenging year across the globe from a volatility perspective.
All right, fantastic. Tony Sacre, it's been an absolute pleasure. We'll wrap up the conversation there, but thank you so much for joining us this afternoon.
Thanks a lot, Leanne. Cheers. Thank you.
Tony Sacre, CEO of the Bentleys Network, joining us there live in the studio.